Over 38 years, legendary investor Sir John Templeton averaged 15% annual growth. He watched investors twist themselves into knots just to convince themselves the current boom breaks all the old rules. Believing those four words about things being different drains more wealth from portfolios than any other phrase in the English language. Pure hope masquerading as deep market insight destroys your capital. Jesse Livermore understood this trap better than anyone. He pioneered speculative trading in the markets and built his fortune shorting stocks right as the crash hit. Authors based the main character of the best-selling book Reminiscences of a Stock Operator on his life. Livermore knew Wall Street never invents anything new because human nature never changes. Speculation relies on those core emotions, remaining unchanged since the dawn of civilization. The same price swings playing out on your screen today happened decades ago and will happen again tomorrow. You might have missed the last one. The setup on your screen mirrors it. You know, the dot-com wreck of the early 2000s and the 2008 financial meltdown. This earlier mania escaped notice. The history books left it out. The sudden collapse wrecked portfolios. The broader stock index dropped 50%. You watched the daily losses multiply. Shares in the biggest global businesses lost 60 to 80% of their total value. The largest corporate names on the exchange bled out. Inflation jumped from 3% to 11%. 8 long years passed before the charts climbed back to even. This was the Nifty 50 craze of the early 1970s. Our timeline kicks off in the late 1960s. America finished a 20-year economic sugar rush following the Second World War. The entire country rode that post-war wave. Manufacturing plants ran around the clock. Suburbs broke out across the national map like teenage acne. New houses sprouted week after week. Everyday citizens felt invincible. Wallets overflowed with cash by the close of the decade. Confidence ran high. Blind optimism took over the broader culture. People walked the streets expecting good news at every corner. The country beat Germany, put a guy on the moon, and brought the Etch-A sketch into the living room. Life felt good. You could feel that energy in the air. The stock market sat in the dead center of that mood. Between the end of the war in 1945 and 1970, equities climbed past 350%. Investment portfolios multiplied in value while the rest of the domestic economy hummed. Green numbers on a brokerage screen kept climbing. That historic bull run birthed a fresh playbook for putting client money to work. Wall Street firms started talking about one-decision stocks. Brokers pushed the idea to anyone with a brokerage account. The underlying playbook kept things basic. You find dominant corporations with overwhelming market power making your only job buying the shares. Timing the market stays outside the equation. The market dubbed this exclusive group the Nifty 50. Penny stocks and unproven tech startups stayed off the list. Established blue-chip giants with steady cash flow made the cut. You looked at household names like Coca-Cola, American Express, McDonald's, and a handful of other everyday brands. Institutional buyers treated those tickers like they were bulletproof. Walking away from a winning position sounded like pure madness to anyone holding a portfolio. The thought of taking profits did not compute to the average person on Main Street. You spot an opportunity that looks safe, promising an easy win. That easy win hides a trap ready to blow up your portfolio. The early 1970s market followed this pattern. You paid Nifty 50 prices untethered from gravity. The broader market traded at a price-to-earnings ratio of 15. That multiple represented a safe, respectable bet. Once you refused to sell, Nifty 50 valuations climbed into fantasy territory. Coca-Cola changed hands at 46 times earnings. Xerox hit 49. McDonald's reached 86, while Polaroid climbed to 90. Those multiples kept climbing. The Nifty 50 average sat at 42 times earnings. 5 companies made up a quarter of the market at the peak. The concentration kept growing. The full Nifty 50 group claimed 45% of the United States stock market. Then the years 1973 and 1974 arrived. Dominoes fell one after another, and reality delivered a harsh slap to everyone. Oil prices quadrupled. Inflation jumped past 11%. Unemployment doubled from 4.5% to 9%. President Nixon ended the gold standard for good. This economic chaos caused the stock market to plunge 50% between 1973 and 1974. You watched the worst bear market since the Great Depression. The failing system obliterates overpriced stocks instead of correcting them once the economy falls apart. Coca-Cola shares fell over 60% in the Nifty 50. McDonald's shares dropped over 70%. Polaroid shares collapsed more than 90%. Those one-decision stocks turned into a giant financial obituary. The final gut punch was the lingering damage. You didn't get a quick V-shaped recovery like the one after the pandemic. 8 years passed before the market crawled back to its pre-bubble level in 1981. Investors who believed they were buying eternal growth stocks found themselves trapped in financial purgatory for the better part of a decade. That was the reality of the Nifty 50 collapse. Staring at the ticker tape today gives you a strange feeling of recognition. Mark Twain pointed out that the past never repeats, yet it always finds a rhyme. The current market beats to that same 1972 tempo, matching the old rhythm step for step. Half a century ago, the Nifty 50 claimed almost 45% of the total United States stock market. You dropped a single dollar into a stock market index fund and placed a heavy wager. You needed those 50 companies to expand enough to justify the absurd premiums attached to their shares. Jump to the present day and the script remains unchanged. The plot holds steady. The production budget increased to fund shinier special effects. 7 American tech giants, the Magnificent Seven, now claim 36% of the S&P 500. 7 names: Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia shoulder the burden for every other publicly traded business. That heavy concentration mirrors the Nifty 50 era, bringing the same risks back to the surface. These 7 businesses build incredible technology and crush their competition. Xerox did the same thing in 1972, alongside Polaroid and Avon products. The Magnificent Seven operate as the modern echo of those 1972 one-decision stocks. You stare at their charts and convince yourself the only choice is to buy. 28 times earnings. Google and Meta trade at that multiple. Amazon trades at 35 times earnings. Apple sits at 37 times earnings. Microsoft changes hands at 38 times earnings. Nvidia reaches 50 times earnings. Tesla towers at 247 times earnings. The prices suggest gravity stopped working. You recognize these as solid businesses. The market also prices them as overpriced, overweighted, and worshipped as if they are bulletproof. Just like in 1972, you tell yourself the same bedtime story. These companies remain untouchable and will grow forever. The only thing missing is a couple of macroeconomic dominoes falling to put you back where you started. Warren Buffett summed up the core lesson of history. Nobody learns from it. You stare at a top-heavy market. You pretend valuations do not matter and whisper a four-word phrase that costs more than any other in the English language. Things are different this time. If you liked today's video, please help us by subscribing to the channel. Hit the like button and tell us what we can cover in the next video.